Hand to you if you raise your hand and indicate that you want to ask a question. We also have some journalists participating via teleconference today, so we'll hope to have time to go to them afterwards. We'll do one question and one follow-up in the room first, and then turn to the phone lines to try to make sure everyone gets a chance to ask their question. Ms. Wilkins will be happy to answer questions in both official languages. Libre à vous de poser des questions dans la langue officielle de votre choix. First question. Nia? There it is, right behind you.
Nia Williams from Reuters. Is there an upside risk to the bank's 1.2% growth forecast for this year?
There are always risks to either side of an outlook, and in fact, we articulate those in our monetary policy report kind of near the end. Of course, one of the upside risks I spoke about in my speech today is just related to the fact that the trade situation, the trade policy situation, is quite fluid, and so it's possible that although the clouds seem to be gathering right now, they could clear, and if some of that were resolved, that would be an upside to not only Canada but the global economy. Of course, those are always balanced with a fair share of downside risks as well.
Okay. And kind of along the same lines, how can the bank remain optimistic about the economy given the concerns and the fact it's clearly worried about some big trade files?
So what we try to do isn't really be optimistic or pessimistic. What we try to do is trace out an outlook that appears to be highly probable, and in fact, the most probable scenario. And when we look at the sources of the slowdown, both globally and in Canada, we can trace it to factors that will affect growth rates, slower investment, a little bit of a rundown in exports, that will stabilize and then start growing from a new level later this year. Of course, for Canada, we have our own particular things. Oil is an example. And much like in 2014, 2015, when we had that big drop-off in investment, 50% drop in business investment, at one point it stabilizes, and then the rest of the economy that's growing kind of shows up more in the headline numbers. And that's the same type of dynamic that's going on today. We expect, again, some decline in business investment, about 20% in the oil and gas sector. But then other sectors, I talked about services investment in those sectors growing, so that investment overall picks up. Housing is an example where, again, there are adjustments being made. Once those adjustments are finished and the housing market stabilizes, we'll see growth from there as well. You got to remember that the context in terms of people's incomes, employment, is quite positive in Canada. Financial conditions are more accommodative than they were at the beginning of the year, and so those are also forces that will lead or support the pickup that we expect.
Kevin?
Hi, Kevin Orland, Bloomberg News. So a lot of analysts interpreted yesterday's rate statement as pushing back against market bets that the bank's next move was going to be a rate cut. Is that a fair representation of the Bank of Canada's thinking?
The Bank of Canada's thinking is clearly articulated in our press release as well in the speech that I gave today. What's important is to look at what underpinned our decision yesterday, which is the fact that we think the economy is on track relative to what we thought in April, that in that context, the current degree of accommodation was appropriate. We say we're data dependent for a reason. Of course, a central bank is always data dependent. There's a particular reason to be that way this time. When you look at household spending, we're looking to see stabilization. We're looking to see what happens in the oil sector, trade as well. Those are all things that we're going to be watching closely, and every decision that we take, every outlook that we do, really is meant to not preclude taking the right decision in terms of monetary policy. So I'm not going to prejudge what Governing Council and including myself and my colleagues are going to decide at any other future date.
And going along with the oil industry, where does the declining investment in the oil industry rank among the bank's concerns for the economy?
Well, it's in the list, and it's interesting because when you look at the adjustments in the oil sector that are the result of the most recent drop in oil prices and the transportation constraints that are there, you really need also to look at it in the broader context of oil markets globally and the shift that's happening in terms of where production is really the most compelling. Shale has really changed the landscape in that market, as well as moves to reduce carbon footprint. And so this adjustment that's happening in oil intensive industries in Canada is something that reflects what's happening today, but a broader force. And so I don't think that we're going to stop thinking about this sector anytime soon. In terms of what is it actually doing to our forecast today, the adjustment to the lower oil prices that happened last fall, as well as the transportation constraints, are shaving 0.3 of a percentage point off of growth this year.
Over to the other Kevin. Oh, Tara, sure. Thanks.
Tara Weber, BNN Bloomberg. You talk a lot about transportation constraints here in Alberta, and we know Line 3 is being delayed. How important and what kind of impact, if we get a negative decision on June 18th for Trans Mountain, will it have?
I can only talk about what it would mean for our forecast. It's important for a number of reasons that are independent of the Bank of Canada's forecast for the economy. We have not included Trans Mountain in our forecast because it's outside the range that's really relevant for monetary policy decisions. So it wouldn't have an impact on our forecast. What we have included is an increase in rail capacity, as well as Line 3 coming on, as you said, later in 2020.
Kevin Carmichael, Financial Post. Could you elaborate on what signals you or the Governing Council is seeing coming from the bond market? You mentioned it today. You said you discussed it at the during your policy deliberations. You noted that that the signals seem to be out of step with what you're seeing in other asset markets. I interpret that as somewhat more a higher level of concern than I read in the NPR in April, for example, where you seem to be sending a message that that we should be expecting yield curves and to invert more often, that sort of thing. So I just wondered if you could, I guess, one, say, has your thinking changed just a little bit between the NPR and today, and elaborate on the signals that you're seeing in the bond market?
So I wouldn't make too much of a difference between the message in the NPR and what I was trying to say today. I'm not sure that it's any different. What we do think is that when yield curves flatten and they invert, we need to pay attention to it, because historically that has been one signal among others that, if nothing else, growth will be slower, and if it inverts quite a bit and is there for a long time, maybe could signal a recession. Clearly, the world has changed a little bit. These estimates or these forward-looking indicators are always based on history. And over history, the neutral rate of interest was higher. And so that meant that quite naturally, the yield curve would be steeper. And so it's likely, combined with compressed term premiums, that these periods of a very flat or inverted yield curve will happen more often. One of the signals for Canada that is quite has in the past been quite a powerful indicator of future growth are credit spreads, and those are the other one example of other asset prices that I had in mind, which still, indicate that there are at least less worries about future growth and profitability than there is in the bond market. The reason that we want to watch it closely is that you never want to discount information. Particularly when it's possible that those who are trading bonds see weaker growth than those who are doing the economists, primarily economists that are doing growth forecasts. And so we like to pay attention to all information.
Do you have a follow-up?
Yeah, a follow-up. The bulk of the speech today was sort of an emphasis on business investment, competitiveness, productivity, that sort of thing. You noted that that many of the indicators that are linked to productivity growth are weaker in Canada than in many of the nations that we compete with. You also noted there's not much the Bank of Canada can do about that. But I did want to know or ask for some elaboration on how the bank does interpret that fact that Canada is a laggard when it comes to many of these productivity indicators, and just how you incorporate that into policy going forward.
Well, it has a direct implication for where we see the potential growth of the economy. So potential growth, the non-inflationary growth or speed limit that's so important to us, gauging how fast can the economy grow before we need to react, depends on growth in the labor force. It depends on capital deepening. So it depends on investment. It also depends on what productivity gains come out of those investments. And so the fewer productivity gains that we have, the slower we can grow without causing inflation. One of the things that we see is that not just recently, but over time, the level of productivity and the productivity growth rate has been slower than some other economies, and U.S. is usually the benchmark example. That's nothing new. We got a little bit less out of the ICT revolution than the U.S. did, partly because we have smaller firms, less scale, but there's also evidence that even across firms that are the same in Canada and the U.S., that Canadian firms tend to adopt technology a little bit less fast than U.S. firms. And so if you want to know more about it, the papers that I was referring to, or those indicators that I was referring to, were studied in a lot of depth by the OECD and other international organizations.
Okay, so if there are no more questions in the room, we'll go to the phone line. I just want to remind people on the call to mute their phones if you're not asking a question. You can mute your phone by pressing *6 and unmute it with *7. No, sorry, I think it's the other way around. No, that's right. *6 to mute your phone, *7 to unmute. And I think the first question is from Theo of Bloomberg.
Hi, good afternoon. Can you hear me?
Yes, we can. Thanks, Theo. Go ahead.
Okay. Hi. Carolyn, can you tell us whether the Governing Council believes that the degree of accommodation between the April and this week's decision has increased, given the loosening financial conditions?
The degree of accommodation that we talk about in our press release, just to be clear, is related to the overnight rate. And so the overnight rate is the same as it was in April. If what we're saying are financial conditions more generally, have they eased? Well, they certainly have eased since the beginning of the year, and they've eased a little bit since. Most of the easing actually happened kind of before, up to the April one. One of the, you can see that in the market pricing that I talked about. What I didn't talk about was mortgage rates. And so we did see, relative to late last year, at least 60 basis points decline in a 5-year fixed mortgage rate. And that's actually quite significant easing, because what it means is that relative to, say, last July, mortgage rates are only about 25 basis points higher, and they may be back to where they were if we check the latest numbers in the spring market. So financial conditions are accommodative, and from an overnight rate perspective, they're exactly the same as they were in April.
Theo, do you have a follow-up?
Yeah, please. Since, well, in your April statement and then again this week, you don't have a reference any longer to higher rates, and you talk about rates being appropriate, but at the same time, Governor Stephen Poloz continues to talk about, hikes being more likely than cuts, and if the outlook materializes as you've forecasted it, that could set the stage for higher interest rates. I'm wondering if you can help kind of reconcile those two ideas for me.
Well, just let me tell you a little bit about how we think about where the interest rate should be. If you look at the current policy rate at 1.75%, it means two things. It means in real terms it's negative, which is pretty darn accommodative, and it also means that it's shy of where we think the neutral interest rate is, okay, which is a much higher level. And so on those two metrics, it still is accommodative. And when you look at an economy that last fall had the output gap pretty much closed, we were operating near full capacity overall, and the unemployment rate near lows, wage growth firming up, it seemed to make sense in October when we last raised interest rates to get a little bit closer back to neutral. The way you square that is to notice that in fact we're in a situation of some modest excess supply, which has come about because growth slowed quite a bit in the fourth quarter. We expect it to continue to be quite slow and below potential in the first, and also below potential growth in the second quarter. And so that's exerting mild downward pressure on inflation. As I said today, it's being offset by some other factors. And so it's really that balance of where we think capacity is going that will dictate where interest rates need to go over time. And we expect the economy to gain some speed throughout the year.
All right, we have time for one last question. That's from Greg on the phone.
Hello. I was wondering, when you spoke about risks of trade wars and the concern that they become a long-term phenomenon, can you give us any sense of how you would make that judgment that we're not in a short-term problem, but there's a longer era ahead of trade disputes?
Well, that would be the toughest thing to do, because it wouldn't be the kind of uncertainty that we faced when we were looking at whether the EU would be extremely disrupted during the debt crisis that happened a couple of years ago, where it's a 0-1 thing. Either it happens or it doesn't. In this case, it's a lot more difficult. It's one kind of step forward and two steps back sometimes, and so it's going to be really important for us to be watching the data. And one of the key indicators about that we're going to see, not only for Canada but globally, is what businesses are actually doing and how they're viewing it. And the longer it goes on, and if it escalates, we're going to see not only suppressed investment, but companies actively looking to change their supply chains to manage the risks that's associated with the fact that they can no longer have confidence in the international world order as they knew it. I mean, the base of any business decision or any business activity has to be that, especially when it's cross-border, is that you can have confidence in the rules of the game. The multilateral system that we've been working with through the post-war period is something that is just integral to how business is done globally. And we're going to see businesses changing their behavior if they start to think that this is something that isn't temporary. I'd love to be able to say that one day we're going to wake up and discover that it's a long-term problem, but I don't think it's that kind of risk. So we're going to have to watch it, and we're going to have to keep having conversations with companies across the country and understand from our counterparts globally what companies in their jurisdictions are doing.
Greg, do you have one last follow-up?
Yes, hopefully to what is a short-term problem. Your speech mentioned the flooding and wildfires and how that could make data choppy. Given all the other things going on, are you going to have to be even more careful about how you interpret the second quarter data and try and take into account the prospect that the numbers could be thrown off significantly by the flooding and the wildfires?
I don't have a good sense of that yet, just because we're in the process of doing our forecast for July, and so I haven't heard the advice from staff on that to be able to answer that question. One of the reasons I mentioned it is because it's really top of mind for people, and whether it ends up in the aggregate data or not doesn't change the fact that it's going to cause choppiness, but of a different nature and a very unpleasant nature in some people's lives. You'll find out in July, when we do our updated forecast, how we factored that in.
All right, so that concludes the press conference. Thanks everyone for coming.